Folks, welcome to the latest edition of Market Signals podcast. My name is Mark Zabicki, Chief Investment Officer at LPL Financial. Joining me for this edition is our Chief Technical Strategist, Adam Turnquist. Adam, how are you doing today?
Hey, good morning, Mark, and thanks for having me on today.
Good. We appreciate you being here, especially as we're closing out 2022 with our last edition of the Market Signals podcast. Today is Tuesday, December 20th. We will not be doing a Market Signals podcast next week, and we'll resume this podcast the first week of January. So this will be the last Market Signals podcast for the year. Can't think of a better guy to do it with than Mr. Adam Turnquist. So with that said, let's cover the disclaimer issues and then get right into the meat and potatoes of what we're here to do. And that's just kind of talk a little bit about what's going on in capital markets and economics, as we generally do. Last week is almost has been a pattern for the last several months. I mean, we can call it, is that the market gets a little bit excited, then Jay Powell or one of his other board members throws a little bit of cold water on things. And that's exactly what happened last week, where the Fed raises its benchmark rate by 50 basis points, which was widely expected. And then Jay Powell proceeded to talk down the market a little bit by indicating the Fed was going to remain rather strict with policy. And it was going to stay rather strict until inflation began to decelerate, kind of more materially, although it has been decelerating actually rather materially, at least the way we think about it. So a couple things here. One, you've always got to pay attention to Federal Reserve board members when they talk about, future policy or give some indications of what that policy may look like. But what you also may be seeing here is what we're calling perhaps a masterclass in jawboning by Jay Powell. And again, we believe inflation is already falling rather dramatically, and our forecast is that will likely continue throughout the last couple weeks of 2022 and then on into 2023. What caught people perhaps a little bit off guard as well, maybe not off guard, but just was another bullet point or bullet points that caused some equity market and risky asset price consternation last week, was the economic data in the U.S. was pretty weak across the board. And given that plus the jawboning by Jay Powell, people just kind of retrenched a little bit from the risks that they were taking in some of their portfolios. And then obviously we've gotten a China COVID outbreak, which has taken the wind out of some equity sales in China. But, that's offset by what continues to be a weakening dollar pattern. So that's effectively what happened last week in general terms. You can see by some of this data on this table, markets were rather weak, specifically in the U.S., although emerging markets were also notably weak as well. Most of the weakness across U.S. equity sectors were in the growth areas of the market. Again, no surprise. Some relative strength in Europe versus the U.S. is notable, but I don't know that that's sustainable as far as we think about it. We're going to touch on that, Adam, I know. So just talk a little bit about some of that variance that you're seeing between equity markets in the U.S. and other equity markets. Just tease it a little bit for some of the charts that you're going to be showing.
Yeah, I think one of the big story there is really related to China and this reopening theme that's starting to play out with a lot of uncertainty. But I think the equity investors in China are certainly getting ahead of it and hoping that it continues. When you look at some of the COVID stats, I'm not sure if that aligns with a full-on sustainable breakout. So when we look at it on a technical level, there's, a pretty good bounce. We're calling it kind of a trader's market when you see how oversold things were in China and really in emerging markets in general. And you've had this shorter term surge in equity prices, but a lot of those are not sustainable from our technical view. And we'll look at that and compare it to US markets as we go through today's presentation.
Okay. Good stuff. And then as we move on to the bond market, things are changing over the last couple of days a little bit. And Adam will get into that. But bond market has been looking like the bond market more of late, at least cleaning itself up over the last several weeks. That did continue last week as the 10-year Treasury was largely flirting with 3.5%. Commodity markets were pressured largely by what's kind of going on in China. So it's probably going to take some sustainable rebound in China economies and equity markets for the commodity markets to get more of a bid a little bit. So we've been not as constructive on commodity markets of late, largely because of that very reason. Looking at economic data this week out of the U.S., consumer confidence, we're going to get a GDP number for Q3 that's probably going to firm up our generally positive view in Q3 economic conditions. And then a PCE deflator number later in the week on Friday that is probably going to confirm for us that inflation continues to ebb lower and perhaps actually be less than what the Fed had forecasted, on its own. So there's that. Looking elsewhere outside the U.S., generally weaker numbers in Germany and across like the business climate, business confidence. Effectively, we are going to get UK GDP data. And then, we've got a little bit of Bank of Japan policy activity overnight. And Adam, I know you're going to touch on that just a little bit. And then finally, later this week, we are going to get CPI data out of Japan, which is running probably a little bit hotter than they would like to see it, just a little bit. So maybe a little bit of a change of message from the Bank of Japan. Key issues upcoming this week. A lot of what we just talked about in terms of economic data, and we're also going to get into where we are in terms of the 10-year Treasury yield and kind of market yields in general, which are a little bit of at a crossroads, and maybe we're getting a resolution on that today. And then that leads us, Adam, to your message in this Market Signals podcast, which is, some of the technical, equity weakness that we've seen. I know you're paying close attention to, so I certainly want you to give the viewers your take on that. And then, maybe almost in summary basis, you tell us if Santa Claus is on the way or if he is not going to show in 2022. So let us know what you think.
Yeah, let's take a look at the broader market in the S&P 500. And since it is the last podcast of the year, I'll just kind of walk through the very quick storyline of the equity markets in the U.S. And the one-liner, it's really been a downhill ride for U.S. equity markets throughout the year. If you think about where we started, Mark, we started the year off at a record high. I know valuations were pretty high at that point in time, along with really optimism. It's kind of the opposite of where we're at right now. So something to keep in mind in terms of where sentiment is and where it can go. And basically what we've seen play out this year, this downtrend that's developed off those January highs, there's been a lot of data to absorb, we'll call it. We've had 4.5% of Fed rate hikes this year, which is unprecedented, not to mention even the global tightening that's happened. That's also unprecedented. A war in Ukraine that's played out, and just the inflation environment and interest rate environment. So here we are coming into year end. I think we're down right around 20%. It's basically, still below this downtrend. We did get a brief retest. We've rallied off these October lows. was actually on a CPI print that came in above expectations, but I think the market took it as possibly, the peak in inflation. And we've rallied 14% off those lows. We got right back to that 200-day moving average that everybody's looking at. And then we had a failed breakout above the 200-day. And, when you are in a bear market and below a downtrend, failed breakouts are fairly common, at least on the bullish side. And that's what's playing out just over the last, several sessions. So we've seen a pretty big pullback right now, starting to see some of that short-term technical damage develop. And what I mean by shorter-term technical damage is just a lot of sectors are breaking below, their 20-day moving averages. We're starting to see shorter-term, 4-week lows get put in within the market, but we're not seeing oversold conditions develop. And I think that's notable. If you look at momentum, the momentum indicator with RSI, you have not got back to this kind of 30 or less reading. That's what we consider technically oversold. So we're not there yet. And we're not seeing a widespread oversold conditions within the S&P 500. The bottom panel in this chart that I brought with today shows the percentage of S&P 500 stocks that are oversold based on RSI. Right now, you're single digits, maybe 2 to 3%. Typically, when you get an oversold market, that number goes to, call it, at least 20, sometimes 30, 35%. So I look at that in two different ways. One, there's potentially scope for more downside and momentum, or two, we're starting to see a divergence. So less stocks getting oversold on this pullback. With the only time will tell how that plays out, but we'll be watching those numbers carefully. In terms of levels that we're watching closely, we still have basically resistance right overhead at, at 3867. And then if we get above that on the S&P 500, the key level there is going to be 3900. There's been a lot of trading activity around 3900 throughout the year. So you think of supply and demand and how support and resistance work. That's a key level to watch. It'd be great, I think, if we can get above that level to close out the week. And then, of course, for support levels that we're watching, 3790, that goes back to the July lows. And then one of the key ones to watch is going to be the June lows. That's 3667 on the S&P 500. And I did show on the following chart just a closer look at how many stocks in the S&P 500 are holding up above their June lows. And I think of that June low level as kind of the gatekeeper. And as we get closer to that level or break it, that's kind of the gatekeeper if we're going to retest the October lows. And when you look at the entire S&P 500, you're still at 71% of the S&P is holding up above those key June lows. So I think that's a pretty positive sign, and that's on a longer term basis in terms of looking at the overall breadth. As I noted earlier, there's a lot of short term technical damage, but we haven't seen a lot of stocks start breaking those key support levels. So we'll be watching this really carefully. And then when you just look at it, Mark, on the sector level, you have the technology sector at 63% of the stocks are above their June lows. And that's about a quarter of the S&P 500 in terms of a weighting basis. And healthcare is the second largest sector. You have 80% of the healthcare stocks holding up above those June lows. So a few positive signs that we're seeing in terms of some of the longer term breadth metrics that we're looking at.
So just so I'm clear, that what you're saying as you look into internals is that even though the S&P broadly is kind of in a little bit of selling pressure here, it's too early to call as to whether that selling pressure is going to be elongated. Is that a fair statement?
Yeah, absolutely. I don't think there's enough technical evidence to throw in the towel on this potentially being a bottom. As we're a potential bottom developing, and maybe those October lows, I still think there's enough evidence to consider those as a candidate for a bear market low. We've been pretty spoiled if you think of the last two recoveries. They've been really this V-shaped recovery, and that's been really a Fed story. When that you did see, 2020 was Fed and fiscal changes with the pandemic, but even in 2018, we did see a shift in Fed policy. and that was basically a V-shaped recovery. When we look at this bottom, we're not seeing a V-shaped recovery. I think it's just going to be a little bit elongated as we wait for, potential Fed pivot, pause. I don't know, whatever you want to call it, Mark, but I think that's going to be a key driver to climb out of this bottom.
Yeah, I mean, we've undergone a lot of technical damage, obviously a lot of sentiment damage, and people are just still trying to get their arms around what the Federal Reserve is exactly going to do, and we probably won't get that answer until early 2023. But it's although we're cautiously constructive in terms of our asset allocation work, because we do think the fall in inflation and an eventual Fed pivot, pause, whatever you want to call it, is going to be beneficial for risky assets. We're clear that it's going to be messy getting there, right? And we're actually seeing that, if that's fair. But let's talk a little bit about calendar benefits that may be upon us, and I'm going to lean on you, Adam, to tell us whether Santa Claus is showing up or not.
My son, who's 9 months, certainly is hoping for Santa Claus to show up and maybe some new Mickey presents, but we'll see. I keep telling him he's coming if he behaves, and he's been pretty good. So all indications are that he's coming. And when you look at just some of the seasonality, I know whenever December kicks off, there's a lot of data that goes out and outlining how great of a month December is historically. If you just look back since 1950, I think the average return is right around 1.5%, and it's one of the strongest months for the S&P 500. When you look at it this year, not the case. I think we're down over 6%. We'll call it right now. We started off with a 5-day losing streak, so that seasonality trend is not playing out. I know some of the tightening that you mentioned earlier on the call, Mark, that's really kind of throwing some cold water on this seasonality. But when you do dissect December in terms of how it usually plays out, it is a second half story. I think there's 8 trading days left, so time is not really on our side here. But when you look at it, most of the gains in December are a back half story. I think right around, depending on the scenario, call it right around 2%. Off the midpoint from December to year end. So still hope for Santa Claus to come. And when we talk about the Santa Claus rally, we're using the Yale Hirsch Stock Traders Almanac definition, which is the last 5 trading days of the year plus the first 2 trading days of the year. And when you look at the returns historically, and this goes again back to 1950, the average return just for those 7 days is 1.3%. So a pretty good, especially on an annualized basis, a pretty good return. Positivity rates there are pretty impressive as well. I think it's right around 80% of the time, that 7-day window, you do trade higher. So something to watch as we go into the holiday season. And again, a positive sign amid this relative negative sentiment that we're seeing. And then just one other thing I wanted to note on seasonality, and a theme that we've outlined before, is when you look at down years, which I think it's all safe to say we're going to have a pretty significant down year on the S&P 500. If you just peek around the corner into next year, following a down year, the average return for the S&P 500 is around 15%, and you finish higher 84% of the time. So you can take all of the headlines out and look at just the data. And I think the data is on our side here as we go into 2023, at least from a historical perspective. Of course, that comes with the disclaimer of, history may not repeat, but as we like to say in the technical world, it may rhyme. So I think there's some positive seasonal data that we can apply to, 2023.
And that's something we lean on, not heavily as an asset allocation committee. Again, we think the course is going to be driven by, what happens with Fed policy, what happens with inflation, how kind of deep is the likely recession that we could see in 2023, which we think is going to be mild. So while those data points are interesting and they're certainly additive to the overall view, it really comes down to some on the ground, conditions that we'll be closely watching at him, and I know you will. We we got a little activity from the Bank of Japan last night. I want to leave that up to you to kind of just touch on that as it relates to the dollar yen cross.
Yeah, so I was looking at this last night and putting together charts, and then I was looking at the futures market, and things were starting to be, in the U.S. green. And then I looked about 20 minutes later, and all of a sudden there was a lot of red on the screen, and part of that was really the Bank of Japan coming out with a big surprise in terms of their monetary policy. They actually revised or adjusted their yield curve control program. So they basically had a 0.25% limit on where they would buy their 10-year Japanese government bond. They lifted that surprisingly to 0.5%. So not a major notional move, but the message was really an off guard. It caught the market off guard. I don't think any economist across Bloomberg survey data had predicted a change in that policy rate, at least at this meeting. So it was a big shocker to the market, and we're seeing that play out on the dollar yen. This is a chart of the currency pair here. It's had this move's been kind of in motion, I think, for a while. When you just look at this overall rally in the yen, or dollar versus the yen, excuse me, it's really been parabolic. And what I mean by that is just the rate of change has been, what I would consider not sustainable by any means. The problem with a parabolic rally is you don't know when it ends. But when it does end, it usually is not it's a crash, and that's what we're seeing play out with the dollar yen. It did take out its 200-day moving average overnight. That's the first time it's traded below the 200-day moving average, I think, on almost 2 years. And now we're seeing it retest kind of this 133 level. That would be a key level to watch. If we break below that, which I think we likely will, we can get back down, sub 130. Kind of in this 127 camp. So something to watch on the dollar yen. I think, the macro implications are interesting, just given that the Bank of Japan was kind of the last major central bank to keep policy at ultra low rates. So there was some anchoring to that, where Japanese government bond yields were. And now we're seeing a shift away from that. I wouldn't call it, an end to their yield curve control program, which they've noted, but I think it is a major policy shift, and kind of the last stakeholder in that zero, or ultra low rate camp. So the implications when you apply that to the U.S. markets or U.S. Treasuries, is that there's the relative value of a 10-year yield loses some appeal, when it's competing assets, especially with safe haven. The Treasury and the Japanese government bonds are, considered some of the safest assets. So it does lose some appeal. And we've seen 10-year treasuries bounce pretty significantly overnight. We brought that chart as well. When you look at what's happened on the 10-year, sorry, I skipped a slide, but
we go to the 10-year.
Yeah, we've seen the 10-year bounce, a pretty good move overnight. Not as much as some of the other global bond markets, but that's one of the implications with that policy move from the Bank of Japan is it is playing out on U.S. In U.S. markets here with the 10-year. Technically, when you look at what's happened, we've seen a pretty big pullback, just over 90 basis points over about a 30-day period on the 10-year. And now, we're seeing oversold conditions develop right into a key area of support. So I don't think it's a huge surprise that we're seeing a bounce off that support level. The catalyst, you can call it last week's, part of it's the relatively hawkish surprise from the ECB and the Fed. And now you have the Bank of Japan kind of joining that party. But I don't think, that we're going to see a move back to the new highs. That's the most important message here. I think the highs are likely in. We'll see a little bit of a relief rally in Treasury yields. I think it'll probably go up to right around that 50-day moving average at 383, at least on a short-term basis. But again, I don't think we're going to get back to the old highs. I think we'll probably consolidate a little bit around 350 as we have over the last several sessions.
Yeah, I think you made a good point, Adam. I think if we move 90 basis points down in the 10-year Treasury to 350, which was going to be resistance anyway, it's no surprise you're seeing some bounce off of that. More work to do in the treasury market. Again, we believe that, based on, a Fed pivot, Fed pause, inflation coming under more control in 2023. Agreed on your point that you raised, and we've likely seen the highs in the 10-year Treasury yield put in already, and the question now is kind of how low do they go? Probably not a whole lot lower as our base case view for 2023, but it's I think investors will likely be able to put to rest the concept that we're going to get to kind of 4.5-5% on the 10-year Treasury yield, because it's just not in the cards, at least the way we think about it. Let's go to I want to cover the EAFE, if you would, just kind of a bow on what we think about U.S. markets relative to other developed markets, and what you're seeing in those developed markets, and what the likely trend is going forward.
Yeah, so we've seen a lot of improvements within developed markets, and we're looking at the MSCI EAFE index here with this chart, and it's outperforming off the October lows. So we've seen a really big bounce, and in terms of the technical progress that we're watching, the EAFE index has reversed a declining price channel. It's actually back above the 200-day moving average, and now we're seeing it kind of struggle with resistance off the August highs. And when we look at it on a ratio chart, especially, it's a key component of our decision making when we're talking about allocations. It's relative, and when you look at this long-term downtrend, this is the EAFE index versus the S&P. So when it's moving higher, EAFE is outperforming. When it's moving lower, the S&P is outperforming. We're starting to see early stages of a downtrend reversal with the EAFE index over the S&P. I think you have to be cautious here before you start making allocation decisions, because you have not made a new high in terms of this ratio chart breaking out from a bottom. So, we're starting to see signs of a downtrend get reversed. But again, you could be bottoming out, or this could take several months. We don't really know. But until you see evidence of a confirmed breakout of a new trend, a new uptrend developing, I think we stick with the S&P 500. And I know, Mark, you could talk about the fundamental side of U.S. markets versus developed. It's a pretty big contrast overall, I think.
Well, it's not surprising often that the technical setup kind of rhymes with the fundamental setup. So in the fundamental setup really is consistent with your technical view, and our view as an asset allocation committee in general is that we're waiting on more positive signs technically before we get involved as asset allocators. We're still overweight the U.S. relative to the rest of the world, and there's good reason for that. In terms of the EAFE, one of those reasons, we just kind of was birthed last night from the Bank of Japan, and then the other reason is largely the uncertainty around energy supply in Europe, and also just kind of the inflation story in Europe. Clearly, they have a tougher inflation road to hoe than the U.S. has got now. We expect that to eventually roll over and things get a little bit better from an inflation perspective, but that has not yet played out. Couple that with the supply issue in energy, and it makes it a tough call to over allocate to EAFE. Given the lack of kind of formal technical development that you highlighted, and just the hurdles that we need to cross fundamentally in Europe over the winter months. So I think Adam, that's going to do it for us. What do you think? I think we've said a lot today, haven't we?
Yeah, I think so. I think we're running short on time probably as well. So
yeah, well, and thank you, Adam, for joining us. I couldn't think of a better individual to close out the year with than Adam Turnquist, our chief technical strategist. Much appreciated. Thank you for joining us again. We will pause in the Market Signals podcast. There'll be no edition next week as we all enjoy our holidays, and we will resume on the week of January 2nd. So stick with us until then. Thanks for watching.